he should be looking at a 1 month return.
Sure.
And justifying his investment in a mutual fund. I think that's a much more longer term thing. But well, if you were to do his financial plan, he says he's got 40,000 now, but I'd like to take it a step forward, and you could even tell him that, look, even the additional money that you earn over the next 3-4 years, this is what you should really do with it.
Sure. Hi Mayank, I think you're doing very well in terms of whatever you've done already. You've chosen some mid-cap funds, you've chosen some growth-oriented funds, which is a good decision, and you've been doing pretty well. One of the things I want to tell you is, out of this 30, 40, 50 odd thousand that you have right now, is consider a little bit of retirement planning. You're young. I think you're very well aware of the returns that are available from mutual fund investments and equity investing. It'll help you very much in the long run. So deploy a little bit of your money, say about 25% of your money right now towards retirement. It'll help you, grow, and it'll help you build your wealth. While you're looking at all the other investments that you have besides your PNB investment, all these investments, I mean, assume that these investments are at least for 5 years if you want to really see a lot of wealth growth, because no equity investment really is an investment which happens for less than 2 years or 3 years. So the longer your investment is, the larger your tree will grow, and the better your money will perform over a period of time. But like you're doing, keep watching your portfolio, keep monitoring it at the same time. Focus on mid-cap for the next 4-5 years, focus on dividend yield stocks, focus on India growth-oriented story, I mean those kind of funds. I'd say avoid funds that are only focused on 1 or 2 sectors, which may not be a very good idea, because you might not really realize when the sector turns around. But otherwise, being on diversified side and some mid-cap side, I think you'll do very well.
I think he's a little too heavy on just the mid-cap funds.
Yes.
You may buy a few more diversified equity funds.
Absolutely, yes. Right. So some diversified funds, some dividend yield portfolios also will give him a well-rounded exposure across the stock market. And then, as I said, a little bit of contribution towards retirement.
Get himself a good term insurance plan, because he's young, he'll get it cheap.
Yeah, I mean, as soon as the as soon as the responsibility comes upon him, maybe that's the right time to buy something. Maybe not immediately, and time's not really running out. I think if he gets married in a couple of years with responsibility, with some debt and all that, then insurance would be a very well justified call.
Right, thanks for that, Karthik. And let's get across to Patiala now, where we've got our next caller, Jagjit Sharma from. Jagjit, welcome to Your Money. Tell us, what would you like to know today?
Sir, I'm age 65 or above.
Yes, sir.
Rather.
Right, tell us, sir.
Now, I have enough money to, I have invested in senior citizens.
Ji.
And my question is, how can I invest safely? I don't want to go to mutual funds, because I have seen their ups and downs every year, many times. I'm in the equity market for the last 20 years.
Okay, that's great experience.
So without that, what should I do? With my 1 lakh of money, I am earning at present 250 or above.
2,50,000 a year.
Yeah,
that's what you're earning, sir. Okay.
Sir, the finance minister has something unjustified for our senior citizens. He has deprived us of many things. Now we have to invest somewhere as or a pension scheme or something which is far of our age.
Okay, that's a good question, Mr. Sharma. Thank you very much for asking your question on air here, and I think you raised some very important points there. But tell us, Karthik, he says he earns 2.5 lakh with all his savings, so he obviously saved well in his life, and he's earning this money. Today he finds that except for the 9% senior citizen instrument that he puts his money in, and that also doesn't give him a monthly return in that sense. Where else can he invest so that he also keeps himself?
Mr. Sharma, what happens is, I know that a lot of things have changed, and tax reforms have not been extremely encouraging towards the senior citizen in that sense, from your perspective. But however, having said this, one, you said that you were a little risk averse towards mutual fund investments. Now, what I would want to suggest to you is that the strategy or the methodology must change a little bit, right? You can go to a mutual fund, you can go to MIPs, you can go to a 5%, 10% equity exposure kind of a thing. See, because there is nothing else which will even match inflation at your age. Whether you buy an insurance annuity from an insurance company, if that was available, or any other bond product, it will not match inflation. It will not give you more than 6% or 7% in that sense. Now, if you have to do anything better than that, then this is the only available alternative, as in within the investment arena today. Go into that. Change your methodology. Instead of expecting a monthly dividend, look at getting a systematic withdrawal plan. So what happens is, over a period of time, you are withdrawing small amounts depending on your need and requirement. You are assured of your income, and over a period of time, because majority of your portfolio will be bond portfolio or a fixed so to say, fixed interest income portfolio, you will not be exposed so much to the vagaries of the market, and it will not really move so much up and down. A 5-10% equity exposure will actually help you to beat inflation or match inflation at least. So I think that would be the most rational thing to do given the circumstances and what we have available with us today. So I think an SWP plan with a mutual fund.
How does it work? Very quickly.
What happens is you make your investment and then you instruct, like the way you do an SIP, it's the reverse of SIP.
So I put a lump sum with the mutual fund and then you keep drawing it and putting it.
And then I keep telling the mutual fund that give me 2,000 rupees every month. So every month units equivalent to 2,000 get sold. So over a period of time my portfolio is also generating.
Where does this money lie? Where does it get invested?
The money could get invested depending on the scheme that you choose.
Scheme is of the investor's choice.
Yes, absolutely. So, and where you can choose how much equity exposure would you want to have, 10%, 20%, 5%. I mean, there is everything which is really available. Even a 0% is available. So you can. There's lots of products, lots of variety. You can really choose what you want to do. My suggestion would be 5 to 10% is a fair thing to do. So it will, help you, stabilize your returns. It will also help you hedge against, interest rate movements and where you might lose actually on a debt fund. So given all these circumstances, I think it's a fair strategy to do a, on a 10% MIP kind of a plan. Go to a growth option, do a systematic withdrawal plan. Choose the amount that you like. Don't choose a very high amount because otherwise your funds will, start eroding very fast. But choose a reasonable 2,000, 5,000, 10,000, whatever is, suitable and comfortable to you on a monthly basis.
Right, thanks for that, Karthik. Time for a break now. Karthik Zaveri will stay on to answer more of your queries. We'll be back in just a moment. Let's also remind you that tomorrow our expert will answer all your queries on investing in unit-linked insurance plans or ULIPs. Do send in your queries and we'll call you back. Welcome back. You're watching Your Money with Karthik Zaveri and we're discussing investment strategies. From Mumbai now we have our next caller, Sanjay Balgopalan. Sanjay, welcome to the show.
Hello. Yeah.
Hi Sanjay, what's your question today?
Yeah. See, I have basically my investments are in equities, mutual funds, and insurance.
All right.
Now I wanted to make investment of around 50 to 55,000. So every year. So whether I should go for some, which segment should I look out for? Whether.
Okay, now if you were to give us a percentage of all these investments, how much of it is in equity, how much of it is in a mutual fund, how much of it is in insurance? Can you give us a quick...
You can say around 15, 10 and 10. Can say that.
15, 10 and 10. This is in terms of thousands or percentage?
Percentage.
So that still leaves you with the rest 65%. What have you done with that?
It's around 50. I told you 15 plus 10, 20, 25 plus 10, 35%. Around 35%.
All right, okay. So Karthik, that's his investment so far. Now he obviously wants to invest 50,000 every year, which I think is a damn good thing to do. Yep. Where should he really be focusing on to build his wealth for the future?
Sanjay, hi. Very straightforward. What I would say is, if you are looking at any instruments, firstly, let's remove the ones that we should not consider, and then we'll come to the ones that we should consider. So if you look at things like PPF, if you look at things like post office, etc., over a period of time, all of these are going to become taxable. PPF is going to become taxable, very shortly once the EET regime sets in.
But there's no clarity on that.
There's no clarity on that, but it's going to happen. So once you withdraw the money in future, you're going to pay some tax on that. So what I would say is, again, coming to the fact that you're basically young, I think you should look at opportunities that are dynamic and opportunities that will give you a chance to improve your wealth over a long period of time. I would say look at pension plans, you look at unit-linked plans, look at pension plans from mutual funds, by the way. Look at unit-linked plans, look at ELSS. That's a beautiful instrument, across a whole diversified, shall we say, area of mutual funds. These ELSS schemes have done fantastically well over the last 4 to 5 years. Now, having said that, they also give you benefit in terms of your tax advantages if you need to take those. And all your investment is essentially tax-free, and that's probably the only vehicle which is going to remain, which will be on a long-term tax-free basis. So that's a great idea. That's a great opportunity that you must consider, and regularly invest into those instruments. Don't invest in a lump sum. Go short. Go small piece by piece. Maybe on a monthly basis you could deploy something. Don't put all the 50,000 at one stroke. Okay, just spread your risk a little bit across the year. Have a slow and steady approach, and keep in mind that you're going to invest for a period of 4 years, 10 years, 15 years. That's really how wealth will grow over a period of time.
What you're really saying is that at that young age, everybody must have a fairly decent exposure to equity, provided you're willing to look at it for 5 to 10 years.
Minimum, yes.
Minimum, absolutely.
Yes, absolutely.
That's the way wealth grows. Thank you very much, Karthik, for joining us today.
Pleasure.
That's all we have on today's show. Do tune in to Your Money, Monday to Friday, ultimate guide to save